Hi, everyone. My name is Richard Robinette. I'm an attorney at Crowdfunding Lawyers, and this is part of our weekly webinar series. And this week, we're going to be talking about private placement memorandums and what's in a private placement memorandum and all the exciting things that go with private placement memorandums. Just a little bit about myself. I'm an attorney. I've been practicing law for almost 10 years now. Been doing securities law for about the last 6, along with my partner, Nate Dodson, who took over this firm with me. I worked for him at another firm for many, many years before that. And yeah, we're rolling on and ready to help everyone with their securities offerings, their investment packages, and all that fun stuff. So cool. Let's get right into things. First of all, because we're lawyers, we have to do a disclaimer. So here's our disclaimer. This is not legal advice. We're not creating an attorney-client relationship by doing a webinar. That would be silly, and you'd be paying us a lot more if we were giving you legal advice. So this is purely for educational purposes. It's not intended to be complete. It's not intended to be perfect. It's just to give you an idea of what's going on. Please consult with your professional advisors before participating in any investment opportunity. Thank you very much. Let's roll on. So what are private placement memorandums? Well, private placement memorandums are memorandums for private placements, but that's not a very useful definition. So let's start with what is a private placement. And a private placement is very simply an offering of securities that's not available on the open market. So most of us, when we think about buying securities, we're thinking about stocks that are on the New York Stock Exchange, and we're thinking about mutual funds that we get with our Charles Schwab broker. We're thinking about CDs. We're thinking about things of that nature, you know, getting on Robinhood and short squeezing GameStop. Those are public securities. These are securities that are not public. They're not available on Robinhood. They're not on any trading platform. They're not, you know, on the NASDAQ or anything like that. You can't go to a bank and buy them. These are only offered privately. So an important thing to know about private placements is they're not registered with the SEC. The SEC does not look at them ahead of time, does not approve them. The SEC gives certain exemptions from registration, and that's what the issuers of these securities are relying on when they put together these private placements. Oftentimes, these are called exempt offerings or unregistered offerings because they are exempt from registration with the SEC. And an important thing is that investors generally have a limited ability to resell these. These are called restricted securities. So there are very strict rules on being able to turn around and resell the securities you buy. You're not going to be day trading these kinds of securities. Generally, there's some exceptions, but generally once you're in a deal, you're in the deal. If the deal goes 10 years, your money's tied up in the deal for 10 years. So if you invest in private placements, please be willing to tie up your money indefinitely, because some of these deals can go on a very, very long time. And it's very difficult to get out of them once you're in. Okay, private placements, a lot of people haven't heard of them, but they're actually really, really, really big business. So to give you a little bit of perspective, if we just look at, where we normally would buy our securities, New York Stock Exchange has about 2,800 stocks available. The NASDAQ has about 3,300 stocks available. Regulation D offerings, and Regulation D is one of the places where private placements are offered. Actually, the majority of private placements come under Regulation D. In 2017 alone, there were 37,785 Regulation D private placements available. So this is a big portion of the investing world, so to speak. Just a couple of fun facts, and this is all from 2017 because it's the most recent year that I have statistics for, but it's recent enough to be meaningful still. More than $3 trillion, it's not a typo, more than $3 trillion was raised in unregistered securities offerings in 2017. About 2/3, not quite 2/3 of that, 1.85 trillion was raised in Regulation D offerings. Now, your average offering size on Regulation D was $32 million, and the median was 2 million. So these offerings come in all kinds of sizes. There's some people that are only raising a few $100,000. There are people that are raising tens and even hundreds of millions of dollars through Regulation D private placements. Another interesting thing is only 9% of Reg D investors in 2017 were unaccredited. And if you unaccredited is a term we use for people regarding their suitability or their ability to buy certain securities. And if you want to know more about accredited versus unaccredited investors, see our last webinar, my last webinar that's on YouTube about structuring syndications. And I talked a lot about the difference between accredited and unaccredited investors, changes in the definitions. Hopefully this number is going to go up. The SEC has been liberalizing the rules a little bit incrementally recently. They've allowed more people to be considered accredited, which gives them access to more offerings. And they've relaxed, for instance, Regulation D, Rule 506B, which previously allowed only 35 unaccredited investors. Now it allows 35 unaccredited investors in any 90-day period. So it's possible for more unaccredited investors to get in some of these deals. They've also raised the limits on other rules or other regulations that allow unaccredited investors. So there are more opportunities coming up for the little guy, so to speak, to get into some of these private placements. So hopefully it's not going to be such a country club, good old boys club, rich people's game. Hopefully this is going to be opened up more and more to the Joe Everyman investor. Okay, so we know what private placements are. What are private placement memorandums? Or is that memoranda? Memorandums? I actually looked it up. And Webster told me that either way is fine. Call it memorandums, call it memoranda, whatever. If you have strong opinions about that and you're watching it on YouTube, please put it in the comments. And we will gladly ignore your rage there. All right, so what are private placement, forget it. What is a private placement memorandum? Well, a private placement memorandum is a legal document that describes material facts about a private securities offering. And I want to emphasize that it's a legal document, it's a securities document. This needs to be prepared by a securities attorney. And I want to take this opportunity to remind everyone that the internet is not a securities attorney. And some of you guys out there, I know I read PPMs all the time. I read them for a living. And some of you guys are cobbling together crap you found on the internet, and we can tell. And that's a great way to get yourself in trouble with securities regulators. Don't take that risk. You're raising hundreds of thousands, if not millions of dollars. Pay a little bit to have a bona fide securities attorney draft your offering documents. Okay, the PPM, private placement memorandum, provides investors with the information they need to make an informed decision. The last thing you want if you're an issuer is to have an investor claim that they were not well informed or that they were not given adequate information. So the PPM is a place where we're going to disclose all kinds of things, anything and everything about the deal, so that nobody can claim ignorance if they decide to get in a dispute with you. And that's important because as an issuer, this is your first line of defense. This is your protection against baseless claims that you misled investors. And if you mislead investors, we can't help you. But if you've been above board and an investor gets mad at you anyway, maybe your returns fell a little short of what you projected. Maybe you even lost a little bit of investor money. Maybe operations or construction or whatever project you're working on took longer than you expected. Investors get mad and investors sue. And when they sue, your first line of defense is that PPM, where you're going to say, look, I told you this. I told you this. You agreed that you read it. go away. There was actually a really high profile class action suit dismissed just the other day based on this exact same thing. The investor it's actually kind of funny. The investor, invested in this deal, and the deal was targeting 5% cash on cash returns for the investors. Well, the guy only made 4.95% cash on cash. And so he sued. And the suit just the other day was dismissed as being without merit. And the reason it was dismissed is because the issuer was able to show his offering documents. It wasn't technically a PPM in that case, but the same type of disclosure document that said, the targets might not come true. You might make less, you might make more, when nobody can predict the future. And the investor signed it, and there's nothing that you can do now. So very, very, very important to have these documents, have them tight, and be able to use them in case a investor decides to be litigious. Okay, so what should be in a PPM? Now, when I say PPM or private placement memorandum, generally I'm using this as an umbrella term to mean the entire package of offering documents. So when you get what I call a PPM, there's going to be several parts. And the first part is the actual PPM itself. So you're going to get 100, 150 pages of documents. The PPM itself is really only like 40 or 50 pages generally. And then everything else will be attached as exhibits. You'll have an operating agreement, or as we call them in Texas, a company agreement. Or if it's a corporation, you'll have bylaws, or if you're investing in a debt offering, promissory notes, whatever governing documents surrounding the investment, those will be included in the offering package. And frankly, the operating agreement, the bylaws, those things, in my opinion, are more important than the PPM itself. The PPM really only matters while the securities are being sold. That's it kind of plays a limited time role. And once the company is done raising money, the PPM doesn't really do anything else. But the operating agreement governs the operations of the company from that point forward. So if a deal lasts 5 years, 10 years, 20 years, the day-and-day relationship between the investors and the management or the issuers, that's all going to be governed in the operating agreement. So it's very, very important that you read that. They'll also include a business plan, pro forma. So even though the PPM or the offering package is not a marketing piece, its purpose is not to convince investors to invest. It will generally include a business plan to show, here's what we plan to do, pro forma, projections of how much money we expect to make over time. Pro forma is Latin for bullshit. But this is what we think investors are going to make. It's going to be a 15% IRR. It's going to be an 8% cash on cash return every year or whatever. That's all lined out in the business plan. That's generally where we see like the flashy pictures and the charts and the maps and the colors and everything, trying to draw your eye and get you to pay attention to that and ignore all the doom and gloom that's in the PPM itself. And then finally, there's going to be a subscription booklet or a set of subscription documents for the investors to fill out if they want to get into the deal. And in the subscription booklet, you're going to have a suitability questionnaire, because not all of these deals are suitable for all investors. Not all investors are suitable for these deals. So some deals are limited only to accredited investors. So the suitability questionnaire is going to ask you several questions to ensure that you're accredited. Some deals you even have to have that verified by a third party. Deals that allow unaccredited investors are still going to have suitability questions, about your experience, about your education level, about your, investing history. What other things have you invested in? Basically feeling out whether you as an investor or whether the investor knows enough to know what they're getting into, that they are sophisticated enough to participate in the offering. Now, if you don't have a lot of experience, you don't have, you've never done business, you've never really invested in anything, you can still get into a lot of these deals, with an investor representative, so someone who can basically lend you their sophistication. And I talk about that in my syndication video that is now living on YouTube. So check that out if you want to know more. And then finally, you're going to have a subscription agreement, and that is the document that the investor signs saying, yes, I read the PPM. Yes, I read all the exhibits. Yes, I understand the risks. And yes, I still want to invest. I'm going to put in $50,000, $100,000, whatever the investment is. Sign here. The subscription agreement usually also includes a counterpart signature for the operating agreement saying, yes, I agree to be governed by the terms of the operating agreement or by the bylaws of the corporation. So you are signing up to be a member of the LLC or a stockholder in the corporation, and I agree to all these terms that were given to me. So all of that together generally is what makes up what I call the PPM, what makes up the offering documents in a private placement. Okay, that's real great. That kind of is the table of contents. Let's dig just a little deeper and talk about substantively what is going on in a PPM. So basically a PPM answers the 5 W's that we all learned in school: the who, what, when, where, and why. So who's involved in the offering? What is it that's actually being offered? Is this a debt offering? Is it an equity offering? Am I buying stock? What are you selling me? When does everything happen? How long am I going to be in this deal? Is this a deal that's going to last a year? Is it going to last 10 years? When am I going to get my money back? Those kinds of questions we need answered. Where does the money go? Once I invest $100,000 in your deal, what happens to it? Who gets paid what? And how does the money flow throughout the entire company? And then why is the company raising money like this in the first place? What's the story behind the offering? What's the plan? So, and we're going to break these down a little more granular as we go, but, kind of what's the overall picture of what we're doing here. And then I'll add a sixth W or sixth and seventh W of what could possibly go wrong. Very, very important question to ask. And it's not a question that you ask to brush off, because things do go wrong. Not everything is rainbows and unicorns all the time. And as an investor, you need to be aware of that. As an issuer, excuse me, losing my voice here. As an issuer, you need to think about the things that could go wrong and make sure that that's adequately disclosed to your investors so there's no surprises coming down the line. All right, so let's start with the who. Great band. What company is selling the securities? So this is going to be, Joe Blow Capital Fund Number 1 LLC. Where was it formed? Delaware, Wyoming, Nevada. Who's in charge of the management? This one's really important. Who's the person behind all of this that's making things happen? Do you know them? Do you trust them? Who are the key principals? Who are the other players in the deal? Who are who's guaranteeing loans on behalf of the company? Who is consulting the company? Who are the professional advisors? Who else is what we call sponsors? Who are the sponsors of the deal that are making things happen behind the scene? They may or may not be part of the management team. So a lot of times there's other people who are making things happen. Maybe people that are raising money, maybe people that are consulting on, if it's a real estate deal, property searches, or consulting on software development or whatever it is that we're raising money for. So we should have all those people listed. We should have their bios or a resume of those people. You may have information if they've done this stuff before. You may have past performance information about previous deals and how much their deals made or didn't make. So you can kind of see their track record. There'll always be a disclaimer: past performance does not equal future results. But it's kind of nice to know whether someone has a track record, right? And then skeletons. And I'm speaking to the issuers now, the people that are wanting to do these offerings. You probably don't want to disclose your skeletons. You probably, if you have stuff in your past Maybe you declared bankruptcy at one time. Maybe you got in trouble with securities regulators or other regulatory bodies in the past. You probably don't, you're probably not too proud of that, right? But it's not the end of the world, and it is something that investors need to know, and it's best practice to disclose. If there's ever any doubt whether investors need to know something about you or about your past, err on the side of disclosing it. We don't have to make a big deal about it, but we're also not going to brush it under the rug. Here's what happened. These are the facts. Invest if you want, don't invest if you don't want, and we can all still be friends. And then the last who I have is who's allowed to invest in the deal. Is this only for accredited investors? Is it only for sophisticated investors? Is it only for people that already know the issuer? Or is it for, anybody? Or if it's, certain types of offerings, you have to be qualified clients, or you have to be, have an even higher standard for who you let in. So, but the PPM is going to tell you who's this deal for, and then are you one of those people? Yes or no. If you're not, throw in the trash. Okay. What type of security is being sold? Is this preferred equity, where I'm going to get a percentage on my money every year? Is this common equity, where I'm just going to share in profits and growth? Is this debt, where I'm going to be a lender and I'm going to hold a note that the company owes me payments on over the years? What business activity is being funded? What are we doing? Are we buying a specific piece of property? Are we just raising money to buy real estate in general that we haven't identified yet? Are we a tech startup? Are we a medical startup? Are we an existing company that's had operations for years and just needs more money for whatever activity? What is this for? Moving on to when. And, when does the offering wrap up? Some offerings are only going to be open for 90 days, some 6 months. Some are going to be open indefinitely, and they will be raising money for years and years and years and years. A lot of lending funds, for instance, will just raise money forever. And, money comes in, and they make loans, and loans get paid off. Sometimes they pay off investors and they're out of the deal. Sometimes they keep their investors in. So, when does all this stuff happen? When can the issuer start spending the investor money? Now, this one's important. So when you have an offering, you're going to have upfront charges. You're going to have the expenses setting up the company. You're going to have the expense of putting together a securities offering. Real estate, you're going to have due diligence expenses on a piece of property. You're going to pay for inspections. You're going to pay for environmental reports. You're going to do all kinds of due diligence. You're going to pay loan application fees. A lot of things that cost money at the front end of these businesses. And a good question for an investor to ask is, well, when I put money in the deal, are you going to immediately spend it on those things? Are you going to immediately reimburse yourself for those expenses? Or is there a threshold amount of money you're going to raise first before you start spending my money? Because if you think about it, if they only raise a little bit of money and all that money goes to startup expenses, then there's no business and the investor's not going to get anything in return. So most deals will have a minimum investment amount that says, we will not start operations. We will not touch the investor money. Break impounds is the term they use. We will not break impounds until we have raised $2 million. Or $5 million or whatever it is. And then once they've raised that threshold, then they are allowed to use the money, start paying off expenses, start operating, and start putting the investor capital to work. If they don't raise that minimum amount by a certain deadline, and the deadline will be stated as, say, 6 months. If in 6 months we haven't raised $2 million, we're just going to return all the investor money, no questions asked. Have a nice day. So when can they start using your money? When will construction or rehab project or whatever goal the company has. When is that going to be done? How long is it going to take to build the apartment complex? How long is it going to take to develop the software? What are your expectations for that? When can investors expect to see dividends or distributions? Deals vary quite a bit. So for instance, you might have an issuer that's going to buy fully leased up Class A, brand spanking new multifamily apartments. And as soon as we close, like that month, we're going to have cash distributions to investors, and we're just going to start divvying up cash basically from day one. Another deal might be buying, a burnout. And, it's going to take 2 years to get all these units back online and leased up and actually making money. And so we're not going to give any distributions to investors for that time. So the PPM is going to disclose, when can I expect to start making money on this deal? Some deals you won't make any money until the investment's sold off and the company's wound down, and then just at the very end they distribute. Here's your initial investment and here's your profit, and have a nice day. It varies. When can investors expect to receive a return of capital? So, again, and I'm talking a lot about real estate because real estate's kind of the pond I play in for the most part. And, if I'm buying a piece of property, I may expect to refinance that property in 2 years. And, out of the refinance proceeds, I'm going to give the investors back their initial investment. Or it's maybe a property I'm not going to refinance. I'm going to buy this thing. Maybe I'm going to buy it cash, and I'm just going to hold it for 10 years and then sell it. And so you won't receive a return of capital. You might receive cash flow along the way, but you won't receive a return of your initial capital until the end. So that's an important win. When will the company cease operations and wind down? Some companies intend to run forever. Some companies are just going to buy a property, operate it 5 years, sell it, and that's the end. And they're going to just close the doors. Those are expectations that are going to be set in the PPM. Now, I will say, virtually always you'll see a qualifier in there that says this is subject to market conditions. If the economy is in the tank in 5 years, we ain't selling the property. We're going to hold on to it until we have brighter skies or whatever, or bluer skies, whatever the phrase is. All right. Where does the money come from? Is this project all investor money, all capital contributions through this offering, or is there maybe a lender? Is there Fannie Mae going to come and lend a bunch of money on this too? Are there other securities offerings going on at the same time? Where's all the money coming into the company, and then where does the money go? And every PPM is going to have a use of proceeds section, which should tell you exactly where the dollars coming from investors are going to end up. So how much of it's going to go to selling commissions to broker dealers? Some deals, you might have a broker dealer making 6 or 8% off the top. The investors need to know that, only 94% or 92% of their money is actually going to reach the project because they're selling commissions. How much of it goes to the attorneys putting the offering together? How much goes to the managers and fees? And fees are one place where a deal can get eaten up. If you've got a deal that has ridiculous fees, or we've got a fee for, every time we blink, the manager collects another fee. You might want to sit down, if you're an investor, might want to sit down with a calculator and figure out, how much these fees weigh down the returns you're going to make. Likewise, as an issuer, you need to stress test your fees and make sure that, I know you want to make a lot of fees, and you should make fees for the services you provide. At the same time, you need to make sure that, your investors are, reasonably going to expect a good return as well. You see some deals, where it's, I got an acquisition fee, a disposition fee, a finance fee, a asset management fee, a property management fee, I can fog a mirror fee, a construction fee. And at the end of the day, there's like nothing left for, there's no room left for any profits. And that's not a good thing. The flip side of that, I've seen deals where like a guy's just doing everything out of the kindness of his heart, and he does all this work and does all this due diligence and doesn't make any money. And that's pretty ridiculous too. So you got to stress test your deals, find the balance so that you're not overcharging, you're not undercharging. And then as a passive investor, make sure you understand how fees are being earned, where that money's going. Do your homework. How much money is going to capital expenditures? How much money is being used for operations? Is any money being held in reserves for a rainy day? Are there any other capital requirements of the company? Those are things. So all that should be outlined in a use of proceeds. And then finally, not finally, but everyone's favorite topic, distributions. How much money am I going to get back as an investor? When am I going to get it? What's my percentage? How is it divvied up? That's all going to be described in a distribution section. And usually the PPM is simply going to summarize distributions, maybe in like plain language. And then the actual distributions, the piece that's going to govern, is actually in that company agreement, that operating agreement that talks about distribution. There'll be a distribution section that says, when we make profits, the first thing we're going to do is pay, this class of investors 6% return. The second thing we're going to do is, split whatever's left 60-40 or 50-50 or whatever. And it just kind of outlines, how does the money, how does each dollar get broken down, being distributed. Okay. And then there's probably going to be a discussion of taxes and tax risks, the tax treatment of the company. Really interesting reading material, but an important thing to disclose if you're an issuer is the possibility of phantom taxes, where a company may make profits, but it maybe holds those profits, doesn't distribute them to investors, but the tax burden goes to all the investors. So as an investor, you may have taxes to pay on profits that you haven't actually seen come into your bank account yet. So anyway, there'll be a discussion of all of that somewhere in the PPM. All right, and then the why. What is the story behind this investment? This part of this gets into a little bit of marketing, because a compelling story, helps people want to invest. Why is the company raising investor funds? Are we a brand new company? We need startup capital. Are we an existing company that's doing a new venture? What's the point of this? If it is an existing company, what do current operations look like? What do current financials look like? Now, a lot of these are brand spanking new companies. We formed the company for no other reason than to do the offering. So there's not going to be any financial history. But if it's an older company, you'll see, a financial picture of the company. And then again, that business plan, that nice glossy, plan with photos and graphs and smiling people and lots of color. And that's, that's there to tell the story of the investment. All right, and then my last W here, my last two W's, what could possibly go wrong? And probably one of the biggest sections in any private placement memorandum is going to be the risk factors. There's going to be risk factor after risk factor after risk factor. And the risk factor section is really a brainstorming exercise where the issuer and their attorney sit down and think of everything that could possibly go wrong in this deal. How many different ways could your money be lost? How many different bad things could affect performance? Everybody now has got a COVID-19 risk factor, talking about how, an eviction moratorium could affect investor returns. Flooding could affect investor returns. There might be an earthquake. There might be a drop in the stock market. There might be massive unemployment. Amazon might close their big warehouse down the street. If this is done right, basically they're going to give off the impression that this is the most absurdly dangerous, speculative, risky investment ever, and you might as well just set the money on fire. That's a good risk factor section. And it sounds terrible because it sounds like you're trying to scare investors away. But, again, if you're ever in a dispute and you ever have to go to court and defend yourself against an investor that's mad at you for whatever reason,
you're going to want that strong risk factor section to hold up and say, I told you so. I told you this could happen. I told you all the risks and you chose to invest anyway. So we want a good, solid, beefy risk factor section in our documents. All right. Speaking of things that can go wrong, you're going to multiply the chance of things going wrong if you don't pay attention to what's actually in these documents. So if you're a passive investor, please read your documents before you invest. You're about to put $25, $50, $100,000 or more into an investment. Set aside 3 or 4 hours to actually read the offering cover to cover. I know it's boring. I know it's legalese. I know it's a little hard to understand. It's not a Grisham novel. But do take the time to read it. And if you're an issuer, please read your documents. Don't just trust that your attorney, is going to give you their stock thing and it's going to be perfect. What's good for one client is not necessarily good for another client, and how one client chooses to do things in their deal is not how another client does. So when your attorney gives you your documents, read the things, ask questions, ask for changes, or ask why things are done a certain way, or if there's a better way or something that's more compatible with how you want to do business. And also, this is a second set of eyes, because believe it or not, I hate to admit it, but attorneys make mistakes. And if you're the issuer, you're the first line of defense against those mistakes when you're delivered your drafts of your PPM. So read the thing. I'm just going to show you a couple things that I've found. These are all examples from actual PPMs that I've reviewed. Things that are problematic. Some are problematic for the issuer, some are problematic for the investors. But things that are important to have caught. And if you were investing, I hope you would have noticed these things. Or if you were issuing, I hope you would notice these things. So first thing, and I see this all the time, where what's described in the PPM and what's put in the operating agreement don't match. It's talking about people that, cobble their, do a DIY PPM and cobble a bunch of crap together from the internet. Like they're notoriously mismatched, because they'll get the PPM from one place and they'll get the operating agreement from some other website, that they found somewhere. And the two are simply not compatible. So an example I actually saw not too long ago was this. We had a PPM. It says the units carry a sharing ratio of 80%. So the discussion was the, profits were going to be split 80-20 with the investors. Okay, that's a typical deal. That's fair, right? But if you read the actual operating agreement, it actually says the distribution of cash may be undertaken in such fashion as the manager determines with respect to the amount to be made to each member. So while the PPM promised an 80-20 split, what the investors actually got was, well, the manager can pay you whatever he wants, and too bad. Definitions. Your PPM and your operating agreement probably both have a definitions section. And definitions is a great place for attorneys to be kind of weaselly, because what we can do, I'm not advocating this, so I wish attorneys wouldn't do this, but what is often done is take a common term and define it in a strange way or a different way or a sneaky way, and then use that term throughout the document. So the only place you would ever catch that this term actually means something else is in that definition section. So for instance, required interest is a term that's commonly used in these deals. And what required interest is what's the threshold to pass a vote? If our members are going to take a vote for the company to do something, do we need a majority? Do we need 60%, 75%, whatever? So the required interest will be whatever percent we need to pass a vote, right? So this deal, and again, this is from an actual deal. It said the required interest shall mean a majority of the units. Units are like the shares of stock, plus the affirmative vote of the manager. So what they've done is make it where if the manager doesn't agree to go along with whatever the members vote, it doesn't matter how big the vote is. You could have a unanimous vote of the investors. And if the manager says no, well, he's got a veto on everything. So for instance, maybe there's a provision to remove the manager for underperforming, and the investors get together and say, we want to kick this guy out, get someone else in charge, and save the deal. Well, to get a required interest, the manager has to say yes. The manager's not going to vote himself out. So basically any vote where the manager's interest is not aligned with it ain't going to pass. And that was very cleverly snuck into the definitions, and everywhere else just said required interest for this, required interest for that. So, bait and switch. So this was a deal where this was a syndication where they went to investors and they said, we're going to buy this one specific piece of property at 123 Main Street. You know, it's a 150 unit apartment complex or whatever it is. And so this is what we're raising money for. That's a syndication. And in my other video on how to structure syndication, I'm talking about the difference between syndications and funds. In a nutshell, funds are just raising a pool of money and then we'll go figure out what we're going to do with it. Whereas a syndication is we are going to buy this thing. Well, here they slipped into the PPM. If the company determines that the target property is not suitable, it may terminate any purchase and sale agreement and renew the search for another target property. Subscribers' deposits, which means investor money, will be used for expenses of the company for the additional searches. So if they choose to, at any time, for whatever reason, not buy this property they promised everybody, all of a sudden we've turned our syndication into a blind pool and investors don't know what they're actually getting into. Maybe this was an A-class apartment they were saying they were going to buy, and now we're going to go check out this mobile home park, or we're going to go check out, you know, some single family duplexes or something. And so the investors frankly have no idea what they're getting into if the company decides not to buy this one property. All right, who's the boss? Control. So you'll see different provisions for removing a manager or for kicking the issuers out of a deal. And, you know, some of them require maybe a really high threshold. Maybe you got to get 75% of the investors to vote on it, or maybe there's a time period to cure, whatever. There's a lot of hurdles generally. It's very hard to remove a manager. And then I came across this one day. This was in a company agreement and says the manager may be removed at any time for any reason by a majority vote of the Class A members. Class A members are just the investors, not including the manager or any affiliates. Okay, so we have a simple majority vote. It's just of the investors. The manager doesn't get a say, doesn't get a veto. Wow, how that's a really lax provision there. And it seems really easy to just kick the manager out if he's not doing a good job. Then it says, upon the removal of the manager, a successor manager shall be appointed by a majority vote of the Class B members. Guess who the Class B members were? It was the manager and all of its affiliates. So you vote the manager out and the manager votes himself right back in. All right, so the bottom line of all this is read everything. Pay attention to what's in your documents, and make sure there's no surprises. And that's all I got. I'm going to move into Q&A, and hopefully Nate Dodson is on the line. Hey, there he is. I can't hear you. We're going to take care of some technical difficulties here. If you're watching this live and you have questions, please put them in the Q&A section. If you're watching this on YouTube, put them in the comments. We'll try to follow up and get answers for you. You can also email me at the address on the screen. You can call the number on the screen, or visit our website at crowdfundinglawyers.net if you want to book an appointment or a consultation with one of us. Do we have Nate's voice?
Can you hear me now?
I hear you now.
Can you hear me now?
Awesome. Loud and clear. Nice.
Wonderful. Well, thank you. I appreciate it. I got all dressed up for you, especially to listen to your amazing presentation.
Just for me.
Just for you.
PPMs are so interesting.
we all know that they are the most dull, boring, wonderful bedtime story there ever was. However, it's also the most important component of both the issuer, the sponsors, as well as the investors, kind of that protection for everyone. So, I do see that you have up there our old phone number. It still rings our main line, but we have a better one. So just in case, anybody's interested or for your knowledge, the Crowdfunding Lawyers, it was based entirely in California. We have since picked it up, still kept our California peeps and love to have them. But we are now primarily based in Texas. And with that, and just trying to limit everybody's being confused, we've got a couple of new phone numbers. Richard, do you even remember what they are?
I'm probably going to butcher it. I think it's, no, I'm not going to give a wrong number on the, it's got a bunch of 4s and 9s in it.
We can make it really, really easy. You can call us direct at 469-444-9999. No, that's the old phone number. I see that's in the chat. 469-444-9999.
That's a good number.
Oh yeah, it's tough to forget.
Well done, sir.
Well, thank you kindly. The even better phone number, 833-506-REG-D. Just for everybody, I've worked with Richard for so very long, and he does know that I like to get goofy with phone numbers and sometimes spend way too much time and money trying to pick out stuff that makes an impact and people can remember. But with that, thanks so much for all the explanation. We do have quite a few, a whole bunch of questions coming up. Let's cover what we can. And then, of course, in the next week or few weeks, let's get together and do another one of these where we answer any remaining questions. Also, next week, I'm going to do another one of these fun and exciting presentations on marketing Reg D, the 506Bs, marketing what you can't market, and the strategies to find your investors. And with that, that'll be next week. We'll get all that information out. Some of these questions, let's just talk about it.
Sure.
If you have an unaccredited investor that is investing into specifically the 506B offerings, what kind of unaccredited investors are they? Can any unaccredited investor invest?
No. So the requirement for an unaccredited investor is they must also be sophisticated. And sophisticated means that they have experience in business and investing or education or things along that line that demonstrate that they understand the risks of the investment. So, you're going to have that. I talked about that investor questionnaire, which is going to have questions about what have you invested in the past? What's your level of education? What business experience do you have? What other things lead you to believe that you're sophisticated enough to get into this? And then again, if you don't have those things, you can get an investor representative who will basically lend their sophistication to you, look at the deal with you and be like, okay.
So the answer sounds to me like anyone can invest as long as they're sophisticated by how you explained it, or they're getting helped by somebody that's sophisticated.
Absolutely.
Well, that sounds like with some proper planning, you can get just about anybody to invest.
You too can invest in a 506B offering.
Really? What are we going to go buy now?
Let's buy apartments.
I love it.
Best deal out there.
Great cash flow. You can never call it safe, but you can never say it's guaranteed. But it sure is nice to have some asset-backed investments there. Okay, so another question is, well, this is going to be an interesting one. Do you think that they're going to change the unaccredited investor requirements when you start taking into account some of these blockchain or other new laws that the SEC is coming out with?
My crystal ball is broken, so I frankly don't know. It does kind of create an interesting question about, do you need to have an understanding of the blockchain and tokenized offerings themselves to be sophisticated enough to invest in them? So that, might make an interesting question whether they need to update the definition of sophisticated to include understanding, at least at a base level, those technologies. So it'll be interesting to see what they do. Generally, I think the trend has been, and I hope it continues. We'll see what happens with the Biden administration, but the trend has been for the SEC to become more and more liberal, more and more, allowing more and more people to get into these deals and kind of democratizing them a little more. So I hope that continues, but we will see.
I'm going to bounce off that with some of the other rules that have just recently changed. I talked about it a few weeks ago, but also with the 506B, you can actually have up to 35 unaccredited investors every 90 days. So there actually is a more attractive opportunity to have a fund that may be ongoing, and you're really no longer capped at that 35 unaccredited investors, unaccredited but sophisticated investors. However, it's brand new rules, and that really makes it fun to dig into. Also, if you are running your own syndication, you may want to supplement your offering with any of the new rules that apply. Definitely, you could reach out to us. We're happy to help you if we didn't set it up already. We definitely are here to assist.
Yeah, and these rule changes are brand spanking new. The most recent changes were March 15th. So the ink's not even dry yet. If you want to know more about that, check our YouTube channel, subscribe, hit the bell.
What happens if you change the deal?
So it depends. There's the lawyer answer for everything. Depends. If this is a material change, change in the very nature of the investment, a change in expected returns of the investors, things like that, then you're going to need to supplement your offering, and you're going to need to go to the investors and say, hey, with a document, you're not going to say it out loud, but your securities attorney is going to prepare a document that supplements your offering and says, here are the changes. We are no longer going to buy the apartment at 123 Main Street. We're going to buy the apartment at 456 Oak Street. Some material changes are significant enough that you have to offer your existing investors a right of rescission. Deal changed. If you want out, sign this paper, get it back to us. We'll give you your money back. No questions asked. Otherwise, we will continue forward with our project. So always, if you have any kind of change, talk to your attorney.
How much does it have to really change in order to have to offer that right of rescission? Are there standards for that?
I wish there were clearer standards. The things I look at is how, the biggest thing is, how does this affect the investors? If they were expecting to invest in one thing and now they're investing in another, that's material. If they were expecting this return and now they're going to get a different return, especially a lower return, that's material. If I'm going to change, we were going to split profits 80-20, and now I'm going to give a 6% preferred return and a 70-30 split. That's a material change. This deal sponsor left. The person who was in charge of property acquisition is no longer with the company. We got this new guy. That's material. So those are the kinds of things that I would disclose. If you typoed the address of the company or the phone number, we're going to announce the change, but we're not giving you a right of rescission.
Perfect. And I couldn't agree with you more. At least when I am looking at this, does it really affect the economics of the deal, the underlying substance of the deal, or the controls? Materially huge changes to who's the management, the sponsor, the voting terms.
Exactly.
You start creeping into that, and it's just pretty important to get everybody to sign off on it, or you're at risk.
And it's kind of like those skeletons I talked about earlier, where when in doubt, just disclose it. Just over disclose.
An amazing rule of thumb. Just better to disclose and not have a problem than fail to disclose, and then all of a sudden people are yelling, screaming, and just to bring up, if a investigation or an audit by a regulator, be it a state level or the SEC, the penalties of violating security laws can be absolutely massive. As high as a loss of your freedom and jail time, as low as return the investors money, and pay some additional, court-ordered or set interest rates. And oftentimes they'll say, and you can never sell another investment for the rest of your life, or whatever time period.
5 years. Or whatever.
There's always those risks. The tough part is if you're not able to give the investors their money back, often it's something that you also can't discharge in bankruptcy. So you can have issues that just follow you forever until you get it resolved. So definitely, if you are ever raising money, make sure you're working with a competent attorney, like Mr. Robinette here. And we have that. I know that's your father, right? Yeah, or any of our attorneys are really just great. But if you were an attorney and wanted to get involved with crowdfunding, where would you start?
I'd probably try to work for one. That's how I got into it. I was actually a client first, and decided I was practicing patent litigation, and figured out very quickly that patent litigation and litigation in general was not for me. And I went and started doing real estate deals, and Nate was my securities attorney, and we did a deal together. And after that deal, I started doing some part-time work in the office, and just here I am.
Many, many, many years later at this point. So, and speaking of managers, this is a difficult one, but and probably our last question. How do you judge the quality of the performance? Like, when do you know that maybe the investment sponsor isn't doing what they're supposed to do?
There's a really strong correlation between a sponsor's responsiveness and how well they're doing. If they are totally running the deal into the ground, they don't want to talk to you. So if your monthly financials start coming a little late, if your email communications from the sponsors, don't happen as frequently, if you email them and they're not getting back to you as quick as they used to, stuff might be going wrong. Of course, obviously, if it's a cash flow deal and your cash flow starts getting smaller and smaller and smaller, is an indication of a problem. If deadlines are being missed, so your PPM is supposed to tell you when we expect to have, however many units rehabbed in an apartment or whatever. If that deadline passes and they've only gotten half of that done, okay, there's problems. It's maybe time to start asking questions.
Well, thanks so much. And the presentation was phenomenal. Do you have any final words of wisdom for me? Teach me something, and anybody else that's still on.
I couldn't possibly teach you anything.
You do every day. How to be a good person.
My final words of wisdom, again, hire a securities attorney, not a divorce attorney, not a generalist. Hire a securities attorney. Make sure they have that securities rider on their insurance policy. Which is very expensive, by the way. It's absurdly expensive. So most attorneys, if they're not doing securities, they're not carrying that at all. And then read your documents before you give people money or before you solicit money. Please, for the love of God, read your documents. And that's all I got. Thanks, everyone. Bye-bye.